All right, folks, let's talk about the top 3 ways you're probably mismanaging your investment account right now. Now, the very first problem, and the one that I'm seeing the most right now, is that people are very, very afraid of financials. Okay, the collapse of Silicon Valley Bank, as well as the other two, were very niche. They happened because of a very certain circumstance having to do with investments held till maturity. Essentially, SVB made some very bad decisions. And I'll show you in a second a bank that made very good decisions, and I'll show you the difference. So right now, what you see on the screen right here is the chart of XLF. This is the SPDR ETF for the financial sector. As you can still see, banks have fallen significantly. When SVB fell, I think it was probably that big red candle right there. And you can see banks are still way down here near the bottom. So I'm going to show you now an example of a bank that actually did this really well. Okay, right here we've got on the screen the balance sheet for US Bank. This is ticker USB. You can see right here, securities held to maturity, right? That's this line right here. These are all of the treasuries that they're holding, expecting to hold all the way until they mature, right? So they're going to hold it for 5 years, 10 years, 20 years, whatever the amount is. You notice in Q4 2019, let me scroll over a little bit so you can see that. Be right there where we've got that zero. Q4 of 2019, they went from 46 million in securities to nothing. What was happening Q4 of 2019? You know? A couple of things happened. There was some significant issues going on at that time that led everybody in the markets to believe that we were headed for a recession. Okay? If we hadn't have had coronavirus, we were going to have a recession anyway. And also Q4 of 2019, that is when the coronavirus started to spread in China. This company, US Bank, way ahead of the game. They saw turmoil on the horizon and they tossed these securities. And then they did, right here, this is the part that floors me, how well they timed this. Look at this. Let me scroll this over. Right here. Okay. You're going to see they held zero all the way until Q4 2021, when rates were already starting to kind of, we were going to start rising rates, right? So remember, Q4 of 2021, that's when QE was winding down and the Fed was saying, hey, we're going to start to raise rates. So this is when they started to buy. And the reason they were at zero all the way until they got over to, here, and you'll see they've been stacking on since then. In fact, they've got double now what they ever used to hold. They used to hold about 46 million. Now they're holding 88 million. The reason for that is that the bonds right now that they're buying, as rates are increasing, and they increased very quickly, the interest rates, remember, they spiked way up. If you go look at a chart of the 10-year Treasury, they spiked way up as soon as the Fed started to end QE and started to barely raise rates. They were front ran by those interest rates, so they started to buy. Now, the reason for that is because they wanted these high interest rate bonds. But here's another thing too. And this is where SVB got hosed. When interest rates rise, bonds that you already own will fall in market value, okay? Because the new bonds have higher interest rates, right? So they're more valuable. So what they've done here is they've purchased a ton of bonds. Like I say now, at Q4 2022, they're up to 88 million in these bonds, which are probably paying 4.5 to 5%, depending on what they were buying. I actually have some CDs from US Bank, and I think they're 5.5. I think they're 5.5. I'd have to look. But the interest rates they're getting on these bonds are just through the roof. I mean, that's absurd. And in 2024, as the Fed has to dump their interest rates, which they will, the market value on these bonds are going to skyrocket. And they can probably sell half of these, get back to their previous holdings of 46 million, which you can see on the screen over here, right? And pocket a butt ton of capital appreciation on the market value of those bonds. US Bank did this perfectly. Like when I found this balance sheet, I was just kind of floored at how well they did this. So everything I just explained it's kind of simplified. So I know there's some of you out there that are yelling at me, well, this isn't entirely correct. Well, I know, I simplified things a little bit. But nonetheless, check out this balance sheet for yourself at US Bank. It's just, this just blows me away. They did this perfectly. So let's jump back over to these charts. Right now, and this is the first way people are messing up, they're not buying financials. Go buy financials. Companies like US Bank, oops, my algorithm stuff up here. Companies like US Bank, look at this drop. This stock is worth at least $10 more than where it's at. Charles Schwab right here, look at this drop. It's in the 50s. This is a stock worth 80, 90 bucks all day. And here's JP Morgan. Same deal. It didn't fall as hard. But the same deal over here. Those are the three stocks I like. US Bank, Charles Schwab, JP Morgan. You can also grab the other big ones like Wells Fargo, B of A. Those are fine to buy as well. So this is the number one thing that I see people doing wrong right now is they've tossed all of their bank stocks. No. Go out and buy them. Don't get out of them unless it's like some risky tiny little regional bank maybe. And then take that money and put it into one of these. Okay, next up, thing number 2. People are doing very wrong right now. You don't have enough tech. Go buy tech. Everybody has sold it off because like its bubble kind of popped a little bit. This big bubble here that was formed right with the easy money policies, right? So everybody's sold it off and it's sold off hard. Okay. I've been buying tech throughout here and throughout here. I've been buying tech. I have a lot of tech. My personal portfolios and my managed accounts are both at 20 to 25% tech right now. Okay, my personal and managed, they're all sitting around 20 to 25%. Have a lot of tech at the moment. Get overweight in it because it's dirt cheap. It still is cheap comparatively. We are still going to see tech go up further, but you want to be in particular places. Things that are overplayed, okay? Social media and streaming platforms. Anything that went up specifically because of coronavirus, like Zoom or whatever. Stay away from all of that. Facebook, Meta, don't touch it with a 10-foot pole. It's done. Zuckerberg's running that into the ground with this whole metaverse thing. But what you want to be in is semiconductors right now, okay? Semiconductors, that whole area, that's the future. The future of the world is paved in ones and zeros, and the only way to calculate those ones and zeros is with semiconductors. Now you can buy XLK as a good proxy to that, but a good one is going to be XSD. That's the Spider S&P Semiconductor ETF right here. Oops. Now you'll notice with this ETF, this thing has recovered a little bit more than the NASDAQ did. That's because smart investors and funds know that semiconductors are a great place to be. You can also buy, now there's three in general big semiconductor manufacturers in the world. There's TSMC, which you can buy. I think it's ticker TSM, right? TSM. Yes, ticker TSM. You can buy that, which is at a really nice place right now at 93 bucks. You can buy Intel, INTC. I think it's like $29 a share right now. because they are building. They're actually they have foundries right now, and I know they're building more chip foundries. They're having some issues getting to the really small nanometer processes, like sub 10 nanometer, I believe. But it's going to be worked out over time, and I think Intel's going to be perfectly fine manufacturing chips. And then the other big manufacturer is Samsung. Yeah, I believe you can buy an ADR for Samsung, but I would just stay away. What I would mostly be interested in here, if you want to get into semiconductors, and again, I highly suggest that you do, if you're not already, is that you go buy XSD. Right here. Go buy that. It's a semiconductor ETF. There's a couple others as well. There's SOX, SOXX, and I think it has leveraged versions as well. So there's a couple ideas with semiconductors. Nonetheless, go buy them. At the very least, go buy XLK. Have tech in your portfolio. Like I say, I'm overweight in tech. As we start to see a recovery, as the Fed has to drop interest rates, we're going to see tech pushing up. I'm going to start to take profits in that, and I'm going to roll it into other places, probably more into real estate, because as rates start to drop, right now REITs are being pressured really hard. As rates start to drop, we're going to see REITs come out from under that pressure, and real estate's going to do really well. So that's probably what I'm going to do, is roll tech profits into real estate. As we get closer to that, I'll post more about it, but you can also start accumulating real estate at the moment as well. Now, the third thing I'm seeing people do that is a problem right now is that you are way too defensive. People are sitting on massive piles of cash. They're sitting on just really defensive stocks. A lot of things like Coca-Cola or Costco or Kroger, which aren't bad companies to own, but they're really over leveraged into defensive. Or again, they're just sitting on cash. Don't sit on cash. Get this money in the market. We're not going to have some sort of giant banking collapse. It's not going to happen. This isn't 2008. Get your money in the market. That's the third thing I see people messing up right now. Go invest. Okay? Thank you for listening. Have a great day.